Hello, my name is Scott Davila, and I'm Vice President of Marketing and Client Relations with Capital Management Corporation. I'd like to welcome everyone to today's webinar, our first one for 2024. We do have quite a few folks who are new to CMC and visiting our webinars for the first time, so I just wanted to take a brief moment to share a little bit about our firm. We're an SEC-registered investment advisory firm that was founded in 1964, so we're celebrating our 60th anniversary this year. We're 100% employee-owned and committed to the highest standards of our fiduciary responsibility to always act in the financial best interest of our clients. Today, we are privileged to be able to work with over 180 individuals, families, nonprofits, and foundations. And so we welcome everyone, not only the newcomers, but also our existing clients who attend regularly. So thank you for coming. Joining me today are Tim Call and Mark Livesay. Tim is President and Chief Investment Officer of Capital Management Corporation, and Mark is Vice President and Portfolio Manager. Combined, they have over 50 years experience in the investment industry. A couple things before I jump into the agenda, housekeeping items. First is questions. If you have a question during the webinar, please type it into the question box. You should have a box to the upper right-hand corner or left-hand corner of your screen. You'll see a list of activities that you can perform during the webinar. You'll see a line that says questions. You just click on the caret, put your cursor in the box, type it in, and either press enter or press send. And we will get that, and we'll get to the questions at the end of the webinar. The second housekeeping item is, as we always do, we're going to record this webinar. We will put it up on our website. We will likely put it up on Tuesday, send out an email to everyone. So if you'd like to forward it to any of your family members or colleagues or even folks that might be interested in Capital Management Corporation, please do so. We'll alert you on Tuesday when that is up on our website. So with that said, let's start the webinar. This is today's agenda. I'm going to start off covering what is a presidential election year and share some historical perspective on how it might affect the markets. Mark will discuss the state of the economy and interest rates, as well as share some historical data on returns following the end of the rate hikes by the Fed, and then Tim will share his insights on the stock market and where our firm sees value. So, whoops, sorry about that. So we are in a presidential election year, and emotions run high, and the market can be unsettling during an election year. Often there's volatility in the market due to the uncertainty, also coupled and combined with the candidates and the media amplifying everything that's wrong with this country and the economy. But as the election date draws near and after the election, the market in uncertainty subsides, despite the party and the policies involved with it. The focus eventually will turn back to the market fundamentals, our strong economy, innovation in American businesses, and so forth, which investors will turn their attention to as the election draws near and the results are in. So let's take a look at this chart on this slide. Historically, there essentially has been no difference on long-term investment returns whether a Democrat or a Republican has held the presidential office. You'll see this chart is dating back to 1933 when FDR was president. And from then to today, we've had 8 Democrats and 9 Republicans in the presidential office. Throughout this period, you can see in the box in the upper left, the average 10-year annualized return. You can see the market has experienced double-digit returns regardless of party affiliation. So the bottom line is there will be volatility and uncertainty throughout this year, leading up until the election, but that volatility will subside, and sticking to long-term investing principles and disciplines is the smart way to invest. You do not want to time the market. It's about being in the market for a long term. So with that said, I am going to pass it on to Mark.
Thank you, Scott. Excuse me. This first chart represents the federal funds rate path. We go back to the onset of the financial crisis, and you see the rapid decline and 2007, 8, and 9, and then the zero interest rate policy that lasted until about 2016. The Fed began to normalize interest rates after that period, and then you see the big decline for the COVID period and the shorter zero interest rate policy following COVID. Since March of 2022, we've had an over 20 times increase in the federal funds overnight rate in just less than a year and a half. Very fast and aggressive rate hiking by the Fed. Of course, this was done in an effort to combat inflation, which has hit 9%. The Fed is likely finished with this rate hiking cycle. However, the timing of future decreases remains uncertain or controversial at this point. Notably, market-based odds for a March cut roughly 2 weeks ago were about 2/3. So at the end of January, there was a 66% chance of a rate cut in March, and sitting here today, those odds are closer to 5%. So the Fed meeting and some inflation and employment numbers came out, and those odds changed drastically. As of today, the odds for a May cut are roughly 35%. So those odds were also much higher 2 weeks ago. And the lesson here is that the market is not particularly good at predicting Fed moves until just days or maybe a week prior to the meetings when things tend to get leaked. It's also hard to imagine the Fed would be in a rush to cut rates with the combination of strong employment trends, inflation at roughly 50% above the 2% target, and solid reported economic growth. So we don't think that the Fed is going to be in a rush to increase or decrease rates in the near future. We believe the reason that after Fed rate hike. Hold on 1 second, get to the right slide. The reason the market tends to be so infatuated with what the Fed is doing is the market tends to outperform or do better than its historic average in the 12 months following the last rate hike. So on this slide, we have the box in green, which is the S&P 500. 1 year following the final rate hike, the average in every cycle since the mid-90s has been a 12-month return of 16.2%. And the 5-year annualized number is 9%. So obviously, if it would be a strong buy signal to anyone that has an algorithm programmed to the market to buy at the Fed's last rate hike. So in theory, that works very, very well. In practice, it's much more difficult because no one knows in real time for sure which rate hike will end up being the last. So just a little reminder for this cycle, the last Fed rate hike was on July 26th, last summer. Since that day, the market has risen roughly 8.5%. meaning that the market still has roughly 7.5% upside until mid-July to hit that historic 12-month average. Importantly, though, the 3 months directly after the last Fed rate hike, those 3 months from July till October, the market went down nearly 10%. So in that time, July, August, September, and October, the market was not yet convinced that the Fed was finished raising rates. So it is very, very tricky to time the market. And Scott mentioned this, but the lesson, as always, is that it's very difficult to time the stock market. It's also difficult to time Fed moves, so we would not recommend doing that. And we're going to then talk about...
Sorry, we're getting a little bit of lag here.
Yes. We're now going to talk about longer-term interest rates. So, of course, the Fed controls the overnight rate, and that's dictated by them. But longer-term bond rates are determined by market forces such as supply and demand. So on this chart, we have the 10-year Treasury yield. So this is essentially the return you would get if you loan the government money for 10 years, or said another way, the amount of money the government has to pay to borrow money on a 10-year basis. Longer-term interest rates have risen meaningfully since their pandemic lows. So you can see the lows in 2020. However, those longer-term rates can only be considered high when compared only to the period of time from the financial crisis until roughly now. The yield on the 10-year government treasury remains well below the average of the last 60-plus years. So the average 10-year yield is roughly 6%, and on about a 62-year chart. This goes back to 1962. And we believe the economy should be able to perform well in an environment when the 10-year Treasury is in the normal range of, let's say, 3 to 6%, and we're certainly within that now. So we don't see too much trouble on the horizon due to high interest rates. And one of the most surprising things about 2023 was the resiliency of the U.S. economy and GDP. Roughly 13 months ago, most economists were predicting very modest growth below 1% or a contraction in 2023 due to the rapid changes in interest rates. The Federal Reserve always notes that rate increases work on a long and variable lag. That's their term, long and variable. I think what they mean by that is it takes time for rate increases to flow through the system, but they don't know how long. And even if they did know how long for one time period or one rate hiking cycle, it wouldn't be consistent from one to the next. So it's a very blunt instrument they use, but it does tend to slow the economy. Given the delayed impacts, economists believe that significant interest rate increases in 2022 and early 23 would hamper the economy during the second half of 2023. However, that did not come to pass. For the year, GDP grew over 3%, and the second half was actually much stronger than the first half. So we've got some of the potential reasons for economic strength on this slide. Employment picture remains strong, wages tended to grow, and productivity improved meaningfully. Workers and companies were very efficient in 2023. Productivity growth of 3.2% during the fourth quarter was well above the post-financial crisis trend level of only 1.5%, and it was even better than the very long-term average of post-World War II until now of 2.1%. We also had excess savings from pandemic stimulus that aided consumer spending, and consumers seemed comfortable building up more credit card debt. Government spending was also robust. Government spending grew faster than the overall economy, which obviously helps GDP. And one of the reasons that the Fed says the interest rate increases have long and variable lags is that interest rate increases do not impact everything equally or at the same time. So if you have a 30-year fixed mortgage rate, or if you have a long-term debt from a company that has been issued at any point since the financial crisis until 2022, the interest payments on your debt don't change, even though short-term rates have gone higher. So we didn't really see the biggest impact in 2023 that you may have predicted given the high interest rates relative to their recent history. Although the conditions that led to slow economic growth forecasts in 23 remain true today. Most economists believe that GDP growth for 2024 will be much lower than 2023, but perhaps it will remain positive. That's the positive outlook. However, unemployment is unlikely to fall more. Excess savings have been dwindling. Credit card balances have already risen and are rising. Further gains in productivity will be harder to come by. And now some of that low interest debt may need to be refinanced at higher rates. However, we think in this environment, investors should be wary of certain cycles that may be nearing inflection points and focus on companies that generate excess cash and pay dividends. Some of the extended multi-year cycles could be nearing inflection points. We have the ones in red that we think are less attractive and the ones in green that we believe are more. Expensive areas of the market include growth stocks, mega cap stocks, no dividend stocks, and just a few must-have or Magnificent Seven stocks. Recently, even within the Magnificent Seven, leadership has become more narrow. So Tesla has maybe been kicked out of the Magnificent Seven. It's no longer magnificent, and some of the other companies maybe shortly. This is typical investor behavior at the end of extended cycles, and we believe we're at the end of this mega cap cycle. More attractive areas include value, mid and small caps, dividend growers, and companies with broader industry diversification. And I'm going to turn the call over to Tim now to kind of go into more specifics on these different trends we're seeing in the market.
Thank you, Mark. We are late in this large cap growth cycle. The market, we are seeing it narrow. We're seeing fewer and fewer of the mega caps performing now. The large caps are expensive and entry price matters. That dictates part of your return. This is a great time to be selling those at high valuations, not to be buying those at high valuations. So we see here that just 10 companies represent almost a third of the index of the S&P 500, and they're expensive, around 27 times earnings. The other 490 companies are only 2/3 of the index and much more reasonably priced. But you don't have to own those 490 companies at 17 times or the whole basket, which on average is a bit expensive. You don't have to own the index. You can pick individual stocks within the index that are more attractive, faster growing, and lower valuation multiples. And you can pick some stocks outside of those 500. Some companies that are more attractive might even have a single-digit PE multiple. When we're forecasting earnings, we see that for various companies like Crawford, Gray, CNX Resources, Agnico Gold, and so they don't even have to be in the S&P 500, but they can have great growth characteristics and very attractive multiples in this environment. As investors have focused on those largest stocks, they've ignored smaller companies. What works long term? Small caps tends to outperform mid caps, which tend to outperform large caps. This is true over 50 years and 100 years. Small companies just have more room to grow, and more of their innovation can reach the market. This graph shows that if you started 31 years ago with $10,000 and just let the money compound, you'll end up with $200,000, and if you invested in large caps, or $254,000 in small caps. Obviously, it's nice to have the additional $54,000, but short term, we've been in this large cap growth rally, So over the last 10 years in this large cap growth cycle, the small caps have only been up 129% versus the S&P up over 200%. So we see that in the box on the right. Usually large cap growth cycles can be 3, 5, 7 years. The longest tend to be 10 years. There are many reasons why we think we're at the end of the cycle, but you see it was at least a 10-year large cap growth cycle, and history suggests it's time to turn. When we look at this chart, people say, well, gee, the large cap growth stocks have done so well. Isn't that what we should always own? Isn't that what's always worked best? When we look at some of the largest companies like Apple and Microsoft, back in the 1980s, they were small caps. When we look at the 40-year track record of Microsoft, you're looking at the 40-year forward track record performance of a small cap. It's not the forward-looking performance of a mega cap. Over the next 40 years, Microsoft's growth should be slower than what it was over the last 40 years. So we're finding some very attractive companies. Some are large caps, some are mid caps, and there are plenty of small caps as well. We've recently been adding to a energy stock this last week that generates lots and lots of excess cash. They can fund internal growth, reinvest it in their growth, and pay down debt, and they still have lots of excess cash. So they have 7% organic growth. They can take some of that excess cash, buy back stock, buy back roughly 7% of their stock. They can grow their earnings then at 15% a year, we believe, on average over the next 5 years. Well, they happen to pay a 5% dividend because they produce so much cash, and they plan to raise the dividend over time. So even if the valuation multiple stays constant at these low levels, recurring 15% earnings growth combined with a 5% dividend yield, that's an attractive annualized return. And that shows some of the attributes we're looking for. Dividends are important, and they might seem small the first year, but they add up over time. So this chart shows that if you reinvest those dividends over time, and this is a 41-year chart, if you started with $141 and spent your dividends, then the portfolio would only be worth $4,700. If you reinvested those dividends, however modest they are, the reinvested portion can continue to grow, and if you're in the right companies, the dividends can grow, and you'll end up with $12,500, a lot more than the $4,700. And the power of compounding and reinvesting and that little bit of extra dividend really helps. Well, we can find some very attractive companies that have growth attributes or undervalued and might have above average dividends and dividend growth because we're looking for companies that generate lots and lots of excess cash and grow over time. Since they have all this excess cash, it happens that 80% of our approved holdings pay dividends. And so many of these are attractive. We have plenty of companies with dividend yields over 4%, like ACCO and Gray. And they're even more with, well, several others with dividend yields of roughly 7% or more, like Kinder Morgan and Service Properties. But importantly, we expect long-term growth from these companies. So it's not just about the dividend, but their long-term growth can happen to allow them to boost the dividend over time. As Mark said, this segment of the market has been overlooked, it's undervalued. In general, the dividend payers would have to go up roughly 14% overnight just to get back to their historic normal valuation. So some areas of the market, like mega caps, are overvalued. Other areas are undervalued. And so companies that produce lots of excess cash and reward their investors regularly with dividends, they're on sale right now. And so if you have to go up 14% just to get to your historical average valuation, that's a great sale. But again, we don't have to own just that group of stocks. We can pick off the individual stocks that we think will grow faster and are more undervalued and possibly have a higher yield. Just 1.5 months into this year, we've already had numerous of our holdings raise their dividends. Other attractive characteristics, we can find industry by industry, and some are benefiting greatly from alternative intelligence, artificial intelligence. And so this chart here shows, you might ask, why do we care about Al's opportunity or hype? And it's artificial intelligence, it's AI. And so people are thinking about the chip companies that make the chips that allow this to work, or the software companies. Well, artificial intelligence uses a lot of data, sorts through the data, and comes up with projections or solutions that are quite probable. And that can save people a lot of time. Saves college students when they need to write a term paper, try to get their computer to do it for them. But it has helped lots of people in our audience with car directions. You're not going to AAA for a lot of paperwork or getting out the map inside the car. Rather, you're letting your phone or other devices help guide you and find the best path there, whether it's to minimize distance, minimize tolls, or minimize time. Well, that's artificial intelligence at use. That's a lot of data, a lot of intersections, and a lot of various speeds, a lot of changing traffic over time of day. And so it's a huge amount of data going through a computer and using software to generate a solution. When we've gone through these technological advances before, it pays to be in companies that benefit, that can use the technology to improve what they do. So while the market's been interested in one or two chip manufacturers and software makers, that technology can easily get leapfrogged. And we see before in previous cycles, when everybody had to pay through the nose for the technology leaders because they knew those would be the leaders for the next several decades, well, those investors ended up paying too much and losing a lot of money. So in the late 60s and early 70s, everybody had to own Kodak and Polaroid, Xerox, and pay a huge amount of money for those because those would be the leaders over the upcoming decades. And those investors lost a lot of money. And in the 1970s and early 80s, well, if you wanted the leading technology, you'll probably buy Tandy, Commodore 64, Atari. Maybe you'll go for some diversification and buy the retailers like Radio Shack and Circuit City. Maybe in the next year, you'll look for a bankruptcy court that would help you. In Y2K.com peak, Kramer could tout the four horsemen. That included Cisco Systems and Intel. Well, they were certainly the technology leaders, but here we are 23 years later, and they're at lower stock prices. Well, that's a horrible 23-year stock return. So entry price matters. When something's being hyped, it's usually too expensive. And where we want to go are in the companies that are at attractive entry valuations that will greatly benefit from today's technology. In healthcare, there are several companies like Bristol Myers, Exelixis, that are using artificial intelligence to scan through hundreds of thousands of molecules and chemical compounds, using the data they find to see what makes the most sense to test and possibly go into clinical trials. And this will save their research departments a great deal of time and allow them to focus their efforts on what has a higher chance of working. In the technology space, we own two companies that innovate a great deal of the chip software technology, as well as transmission technology. So Qualcomm and InterDigital, that reported earnings today, they own a high proportion of the patents in the 3G, 4G, 5G, 6G space that's transmitting a lot of data. Well, artificial intelligence, AI, needs a lot of data, and you need the computers need to share the data. You need to get the data to the right computers. You might need real-time data, a constant feed, and so you need advanced transmission networks. You need to use the technology being created by companies like InterDigital and Qualcomm. And then in media, the local broadcasters can input, just like we were talking about with car directions. Well, they can input various information like viewer demographics for their different shows. They can input what local advertisers might benefit the most from different types of viewers, and they can input what ad spots are available at what prices, and they can match up, and they can narrow down the list of who might pay the most for those advertising spots, who might benefit the most, and that allows them to pinpoint who their marketers should go to sell those advertisements. So that increases productivity, that sells more of their inventory, raises revenue. There are different demographics for who watches the morning news, who watches the midday news, and who watches the evening news. And if you're watching the late night news, maybe you need an advertiser for sleeping aid products. But some of these local media companies are very excited about how AI and this sorting will greatly help their local revenue. And so there are various industries that can benefit from AI. We're looking at many trends of different types besides AI. And when they can boost productivity, when they can provide cost savings, when they can boost revenue growth, that's terrific. And it doesn't have to be just a chip maker or just a software company, especially overpriced ones that might not do well over the next 10 or 20 years. We're screening the whole universe of stocks on growth of earnings and excess cash generation. From these, we're looking for the leaders in growing profitable niches. These companies are growing their excess cash generation and using that to reinvest in their future growth, pay down debt as it comes due instead of paying higher interest rates as debt rolls over. They might pay dividends, and most of ours happen to raise their dividends annually. And if they have so much excess cash, they can repurchase some of their stock. When we look at the great diversification in the portfolio, you have the diversification by sector, but not by cash generation. We just want those cash cows. We just want those excess cash generators. And so it doesn't matter what size. We can be diversified by size, by geography, by industry. And we know what works best over time. Companies with growing earnings and growing cash generation do quite well over long periods of time. Companies that pay dividends do better than the market over long periods of time, and those that increase their dividends on average do even better. And we can use the volatility in the market, whether it's volatility around election time, other seasonality traits, or volatility just off the daily news. We can use that to our advantage. We can watch for very attractive entry prices. And entry price matters. It's a big part of return. And right now, the mega caps are at great exit prices, which means an index dominated by large cap stocks is at a good exit price. We're finding individual stocks at very attractive entry prices. We're excited. We're looking forward to the years and years of compounding. And if we can compound the earnings growth, possibly achieve a higher valuation multiple over time, and receive dividends and dividend growth, the forward returns should be rather nice over 3, 5, 10 years. And I want to thank you for joining us. And back to Scott.
Thanks, Tim and Mark. Okay, we're going to jump into questions. We do have first question here, and Mark, this is probably for you. What are your thoughts on regional banks?
Oh, thank you. This call is another time that regional banks are kind of in a hot topic. So everyone, well, hopefully you don't remember, but last March, Silicon Valley Bank failed. There was a run on the deposits. Another bank called Signature Bank in New York also failed. And it was taken over by a bank in New York called New York Community. And just 2 weeks ago, New York Community shocked their investors in the stock market by announcing earnings that were way less than people had forecasted. They also had to cut their dividend from 17 cents per share per quarter to just a nickel, 5 cents per share per quarter. The reason for this was not deposit outflows. So the difficulties were different. It was that they had to pay their depositors more. So as interest rates go up, people are now getting used to making money on their cash. So they have to pay their depositors more, and sometimes those deposits would leave, or they had to pay them more, so their net interest margins were falling. Also, regional banks tend to have more concentrated commercial real estate exposure. There were a couple of building loans that went into non-accrual, or in layman's terms, went bad, and they had to provision for those losses. So their earnings were greatly negatively impacted. So we still don't think regional banks in general are out of the woods. They're facing net interest margin pressure due to interest rates. They're facing potential credit pressure due to commercial real estate, whose outlook changed meaningfully in March of 2020. So there are a lot of buildings that may have been financed prior to that period that had a kind of different world outlook than they would have today. So if you have an office building, particularly in concentrated cities where people don't want to come in as much or have gotten used to working from home, the companies don't need as much space, so the owner of those buildings and the financer of those buildings may not be having a very good time with those into the future. So we would say it's still a little early to hop into regional banks. That is an area that I have a lot of professional experience with, so I'm always keeping up with it. But right now, there's too many other good opportunities that we're finding to really concentrate on those.
Thanks. We have a question here around CPI numbers. It seemed that the market overreacted Monday of this week when CPI numbers came out higher than expected, then snapped back over the last couple of days. Do you think we'll see this trend continue?
So we'll continue to see volatility with the numbers in the market, and CPI is consumer price inflation. the Federal Reserve's raised interest rates, overnight interest rates, to try to contain inflation, to try to slow the economy enough so that inflation moderates. But it's hard to contain inflation. It's hard to put the genie back in the bottle once it's out. And some people are still facing rents going up, other costs going up. When you go out to a restaurant, when you go to the movies, you might notice higher prices. And so various entertainment costs and other living costs are still rising. And so we see that as a continuing trend. We don't think CPI will ever go negative. And when you look at homeowner equivalent rents, well, even if the home price stays the same, the cost is going up because you can't finance that house at 3% anymore with a mortgage. You would have to go out to 6, 7 or so percent. Well, that adds a lot to the cost of the house. And with the past increases in home prices, eventually your city or county will realize that the value of your house has gone up, and they'll probably assess it for more, and then get more tax revenue from you. Well, that's yet another form of inflation. So there are lots of components of inflation that lag over time. So you have the initial price increases, but then other items increase later. Another one is wages. Some unions have 3 or 5 year contracts. We've seen some of those come up over the last year, and different companies have negotiated for big wage increases in those contracts. But there are going to be plenty more that come up and have to be negotiated. And they don't want to negotiate to today's or this month's inflation level. That they want to look at the inflation level over the last 2 or 3 years and have a catch up for all of that. So there's going to continue to be pressure in the economy and price increases in various areas of the economy. And so we see those that continuing. So unlike Wall Street that thinks interest rates will be cut in the near term and cut severely, we think because of continuing inflation, the Federal Reserve will be slow to cut interest rates, and we think we could be at this for overnight rates 5%, 5.5% level for a good part of this year, and long bonds similarly. We see them more likely to stay close to the current level than plunge as Wall Street thinks will happen. We can use this volatility, whether it's in the bond market or stock market, to our advantage and pick off great buys created from this volatility.
Next question is, how do you view Bitcoin now that Bitcoin ETFs have surfaced?
Thank you. So we don't really view Bitcoin as either an equity or fixed income investment. It's theoretically a currency. We don't do much currency investing. We've never bought dollars or yen or British pounds or euros. So we don't really consider it that closely for our investment portfolios. As we've mentioned a lot on this call, we're looking for things that are generating cash and excess cash, and then can deploy that cash in ways that are positive to their shareholders. Bitcoin does not throw off any cash. I think the way most are thinking of it is like a virtual gold, so something that would hold its value in a downturn or potentially have a spike up in price because there's a limited supply, and once that all that supply is gone or hard to get, each Bitcoin will have to be worth more in value. I think the tricky thing is, in order to realize any economic benefit, you have to buy Bitcoin at price X and then sell Bitcoin at, X times some number greater than 1. And it's just really hard to time that, time Bitcoin. I think it hit close to 15,000 maybe 6 or so months ago. I think is now over 40. My understanding is that when the news of the ETF broke, Bitcoin price actually came down. I think there were probably people waiting to sell that news. And now that the Bitcoin ETF is in place, I think the price has recovered a little bit. But that's just really not something that we consider an equity or fixed income investment because it doesn't have any of those characteristics. So we could talk more about it for a specific circumstance, but in general, I don't think you'll see that in any of the broader portfolios.
One of our holdings, Wisdom Tree, offers lots of ETFs, and they were able to have their Bitcoin ETF launch last month in the U.S. So it was one of those that the SEC approved, and so we're making money off Bitcoin, which is nice. And so that's the stock's gone up so much it now has less than 2% yield, so it's not in our portfolio is focused on high dividends, but is in various portfolio models that we have. So you can tell all your friends that you're making money off Bitcoin right now through those management fees.
Okay, Tim, I think this one's for you, since you talked about it earlier. The movement to AI seems to be valid, but has a lot of hype, especially with companies like NVIDIA. How is CMC approaching and researching AI potential companies for potential positions in CMC portfolios?
Well, we're looking for companies that will benefit from the from increased productivity that can be generated from AI. So if they have a way to use AI to greatly benefit them, lower their costs, raise their sales and revenue, we're certainly attracted to companies that will be enhanced from their increasing use of AI. So AI has been out there for about 2 decades. And again, we're all using it when we're having our phone tell us how to get from one location to another. But there are many uses, and as we, as companies learn how to and adapt to how to benefit from using all this data, their growth rates should increase. So there has been a lot of hype. There has been a focus on a very few names, and because their valuations have gone up to such excessive levels, we find that to be similar to prior technology peaks where, again, everybody had to buy Kodak, Polaroid, Xerox at the high. Everybody had to buy Tandy, Atari, Radio Shack at the high. And then Cisco and Intel 23 years ago, and now they're at lower prices today. So the way we're researching it is who is adapting and using this technology to their advantage. And we have some drug companies that are using it to sort through the early stages of chemical and molecule research to see which molecules and chemicals have the traits where they should really focus their time. And so they're narrowing their search and increasing their productivity that way. It should increase productivity of their R&D departments a great deal. Of course, the payoff it happens over multiple years. It takes a while to test those drugs and get them through the whole process. But this might shorten the time a little bit. Directly in technology, we do like Qualcomm and InterDigital, and they own a lot of the patents, and they're making a lot of these innovations needed for the chip engineering, software development, and the transmitting all this data. And we highlighted an example with media, just like you can have directions in a car, take you to where you want to go, and put in whether you want the shortest distance or the shortest time period to get from one point to another. Media can do something similar with advertising. For each show, what are the viewer demographics? For our locality, what were the advertisers? Who would benefit from those selling to those demographics? And when do we have open time slots? And where can we raise our prices? And you can have a computer help you with that, so that the marketing department spends less time trying to figure things out and more time getting in front of the potential advertiser and locking in some revenue. So we're looking at many, many different examples of that, who can use the technology to their advantage and increase their growth rate and margins from that.
Great. All right, we have time for one more question. And if we did not get to your question, we'll try to get back with you on an individual basis. But last question here for the day is, what do you think of today's international equity valuations?
So that's a great question. It is very broad. International obviously encompasses a lot of different markets, so it's hard to say specifically what, all international markets are the same. So from a top level, in general terms, international equities are cheap versus their U.S. counterparts. So we think they're attractively valued. However, part of that is due to the makeup of those certain markets. So certain markets don't have technology, for instance, as a very big sector. They have a lot of banking. And even within the U.S. market, there's a huge difference between the PE ratios of technology companies and banks. Other international markets have heavy material exposure. So they might have oil and gas, they might have copper, they might have gold. So they tend to be concentrated in those sectors which come with lower valuations generally. And then you have the old adage that if the U.S. sneezes, the rest of the world gets a cold. The U.S. economy has been, I think, more resilient and faster growing than most of the rest of the world has been. China has stumbled since the pandemic, and it seems to be like they are continuing to stumble. So we would be a little worried about that. And then we have a land war in Europe, we have violence in the Middle East, and then we have potential for conflict with China and Taiwan. So there are a lot of things to worry about. So we don't look at the international markets from a top level. We would look for companies that have exposure to fast-growing areas. So we're always interested in trying to find companies that might have international exposure, and you don't have to be headquartered in a certain environment or geography to generate revenue in international markets. And so we do have a lot of the portfolio that might have up to 50% or more of their revenues generated outside of the United States. And in some cases, it's very fast growing.
We usually have around 8 to 10 of our holdings have 50 to 100% of their revenue come from outside the United States. So we are benefiting from global growth, just not necessarily taking direct currency risk. And certainly we judge companies by which geographies they do have exposure to. And if there's an invasion of Taiwan, there might be some trade restrictions that occur after that. And that's something we take into account, and because we're looking also for overall risk management and don't want a great deal of exposure to a problem that might have a high probability.
Great. Thank you, Mark and Tim. And thank you for those who submitted questions. We once again want to thank everyone who attended today's webinar. As I mentioned at the beginning of this call, we have recorded this. We will post it on the website. You likely will get an email alerting you of that on Tuesday. And we once again want to thank everyone for attending, and have a great rest of the day. Bye.
Thank you.